Hey everyone, this is the first of 5 videos where I go over some very important investment trends that have been impacting most people's portfolios. All right, so today what I'm going to be going over is the performance of the US stock market relative to the international market. And the proxies that I'm going to be using are the S&P 500 versus the Morgan Stanley EFA index. And in particular, SPY, which is the Spiders S&P 500 index, and EFA, which is the iShares Morgan Stanley EFA index. Okay. So one thing that's important to recognize when you're talking about trends is the time frame of which you're looking at, right? It's very important to recognize that. For me and for my clients, I'm certainly more long-term focused. I'm definitely not a day trader. I'm going to share my screen here. So what you're looking at right here is a ratio, and it's a ratio of the S&P 500 relative to the Morgan Stanley EFA index, okay? So the way that this ratio works is fairly simple. When this line goes up, US is outperforming international, and when this line goes down, international is outperforming the United States. This chart goes back to the summer of 2017. So I would consider this fairly short term. Okay. And when you look at this, it's fairly simple. You see each of these peaks, for the most part, are higher than the previous peak. And each of these troughs or lows are higher than the previous low. What is that? Well, it's a trend, right? So that is a trend of more times than not, the S&P 500, which again, for the purposes of this video, is meant to be a proxy of the US stock market, it has been outperforming the international market. So this is a short-term view. And what you see is really since about September 3rd of 2020, international has actually been outperforming the United States. Okay, so that is a quote counter trend. And it's a very short period of time. You're talking about just a couple months. And as you're going to see here in a little bit, this trend has been going on for a very long time. So I certainly would not say yet that international is the place to be. I would say that for all of my clients, I've been underweight international for a long time, have owned very little of it. And really for over a year now, I haven't owned any international. And now you're looking at a chart that goes back to 2007. So certainly a much longer time frame. And here you see the trend is much more obvious. What looked like maybe a change in the trend looks nothing more than a blip. And this is really the time frame of which I typically look at for clients. So again, you see really ever since the previous recession, what we now call the Great Recession began, which the Great Recession, the stock market peaked in October of 2007. Really ever since then, more times than not, the United States has been outperforming international. Okay. Now, if we want to step a little bit further out on this time frame, you'll see that it is possible for international to outperform the United States. Now we're going back to where, it starts in June of 2001. And you really see from 2002 all the way to 2007. So we're talking about a 5-year window where international destroy the United States. And I remember being an advisor back then, and it was very common for portfolios that had 100% stocks to be 50% international or more, right? Because it worked during that time frame. But again, for a very long time, this has been the trend. And this trend has been simply US outperforming international much more times than not. And there's really just no debating it. And I know that there are some people that would really point out that over the past 50 or 70 years, it made sense on a risk basis. It made sense on a return basis to have international in your portfolio. But my response is to those type of statements is always the same. Who the hell has 50 or 70 years time frame? Plus, just because it worked for the past 70 years doesn't mean it's going to work for the next 70. So the thing that I love about charts is that it is what it is, right? It's not opinion. It's not even valuations. Because what many would say is that the valuation of the international stock market relative to the US market is cheap. That's true. But there's not a specific point let's go off the PE ratio, where if the PE ratio difference is X, that boom, they all of a sudden switch and international begins to outperform. That's just not how investing works. Things can stay expensive for a much longer period of time than one expects, and things can stay cheaper for a much longer time than one person might expect. And this is from JP Morgan. So I just pulled this up from their most recent quarterly commentary. And this is the PE ratio, the price to earnings ratio, which is the most common metric used to determine whether or not something is expensive or cheap, of the Morgan Stanley EFA index relative to the S&P 500. Okay, so this is a forward PE ratio. And when this line goes down, it means that international is cheaper relative to the S&P. This dotted line right here is the average, okay, the average over this time frame, which is the past 20 years. You see that international has been cheap relative to the United States really since 2015. And it keeps going down. And yet, if we go back to this chart, if we look at 2014, what we will see is over that time frame, what has happened? Despite international being cheaper and only getting cheaper relative to the United States, the US stock market continues to outperform. So at some point, this trend is going to change. But right now, the trend is what it is, and that is US based markets have been outperforming US based markets. So hopefully you found this informative. Again, look for the next 4 videos. Have a great day.